Welcome to another episode of Regtalks. In the next few minutes, we'll walk through 11 key tax developments from the past week, reported by RegFollower. Austria's progressive corporate tax, Belgium's extended Pillar 2 notification deadline, Cyprus's qualified status for EU-wide filing, Portugal's CIT deadline extension, Romania's OECD-aligned transfer pricing rules, the UK's new controlled transactions schedule, the UAE's Pillar 2 registration, Kenya's income tax filing deadline, South Africa's global minimum tax guidance, Bolivia's automatic tax relief, and Vietnam's country-by-country reporting. Let's get into it. Austria sets out progressive corporate income tax. We begin in Austria. The government's draft budget, accompanying Act 2027-2028, sets out a package of tax and spending measures aimed at fiscal consolidation and reducing the budget deficit. The headline change is a move to a progressive corporate income tax from 2028. The standard 23% rate holds on taxable income up to €1 million, with a 24% rate applying above that threshold. The package also raises alcohol excise tax by 30%, tightens anti-tax fraud rules, increases taxation of certain real estate gains, introduces a €2 package tax, and extends higher banking sector levies. For companies operating in Austria, the shift to a two-tier corporate rate marks a notable departure from the long-standing flat rate system. Belgium extends GIR notification filing deadline. Staying in Europe, Belgium's tax authorities have extended the deadline for multinational enterprises and large domestic groups to notify their designated Globe Information Return filing entity, giving taxpayers until September 30th, 2026 to complete notifications for the 2024 and 2025 assessment years. The notification portal opens on July 1st, 2026. The extension provides additional time to comply with Belgium's Pillar 2 Global Minimum Tax Act, which implements the EU's 15% global minimum tax framework for groups with annual revenues of at least €750 million. Cyprus cleared for EU-wide Pillar 2 filing. This week's In Focus segment turns to Cyprus, which has been cleared for EU-wide Pillar 2 filing after the European Commission confirmed its qualified status. For multinational groups with Cypriot constituent entities, qualified status means local filings can feed into the broader EU framework without duplication, simplifying how top-up tax obligations are reported across member states. Portugal further extends CIT deadline for Form 22. In southern Europe, Portugal has again extended the deadline for filing the periodic corporate income tax return Form 22 and making the related payment for the 2025 tax period, pushing it to June 30th, 2026 from the previous June 19th date. Announced on June 17th, the measure applies to corporate taxpayers whose tax year matches the calendar year. With more than 100,000 expected returns still outstanding by mid-June, the government framed the extension as a way to improve filing accuracy, reduce errors and corrections, and enhance administrative efficiency. Romania moves transfer pricing toward OECD-aligned framework. Romania's National Agency for Fiscal Administration has published a draft order updating its transfer pricing rules to align with the 2022 OECD Transfer Pricing Guidelines, replacing the existing 2016 framework. The proposal revises transaction thresholds, strengthens documentation and functional analysis requirements, and introduces stricter comparability study standards, including greater disclosure obligations. It also provides specific guidance on intra-group financial transactions, intangibles, and restructurings. For groups operating in Romania, the message is clear. Documentation expectations are rising toward the OECD standard. UK consults on International Controlled Transactions Schedule. Across the channel, HMRC has launched a technical consultation on the proposed International Controlled Transactions Schedule, a new reporting requirement enabled by the Finance Act 2026 and intended to apply to accounting periods beginning on or after 1st January 2027. The ICTS is designed to support automated transfer pricing risk assessment, improve compliance, and reduce lengthy inquiries queries through more targeted HMRC interventions. The consultation seeks feedback on the draft regulations and implementation design while minimising administrative burdens, and remains open until 31st July 2026. UAE opens Pillar 2 top-up tax registration via EmaraTax to the Middle East. The UAE's Federal Tax Authority has activated Pillar 2 top-up tax registration on the EmaraTax portal, requiring in-scope multinational groups to assess their obligations and prepare documentation. The requirement applies to constituent entities within groups with annual consolidated revenues of at least €750 million in 2 of the previous 4 fiscal years. Registration can be completed individually or through a domestic designated filing entity. The regime implements a 15% minimum effective tax rate, with the first top-up tax return for the year ending 31st December 2025 due by 30th June 2027. Kenya notifies taxpayers of 2025 return filing deadline. Moving to Africa. The Kenya Revenue Authority has reminded taxpayers that income tax returns for the 2025 year of income must be filed by 30 June 2026. To ease compliance, taxpayers may declare valid business expenses not supported by ETIMS or TIMS invoices, provided those expenses are uploaded for later verification, a concession that applies only to 2025 filings. From the 2026 year of income onward, all declared income and expenses must be backed by valid electronic tax invoices, and late filers risk default assessments. South Africa issues global minimum tax filing guidance. Also in Africa, the South African Revenue Service has issued guidance on submitting global minimum tax returns, declarations, and related calculations through e-filing under the OECD/G20 Pillar 2 framework. The Global Information Return supports reporting of top-up tax liabilities and information exchange between jurisdictions. First-time filings are due within 18 months of the end of the first reportable fiscal year, with subsequent returns due within 15 months. The guidance also covers registration, supporting documents, corrections, payment procedures, and post-submission correspondence. Bolivia launches automatic tax relief scheme. Across the Latin America, Bolivia is implementing a major tax relief program under Law 1733, automatically cancelling tax debts for around 252,000 taxpayers without requiring applications or office visits. From 25th June 2026, debts accrued through 31st December 2017 and during 2020 are fully forgiven, including principal, interest, penalties and surcharges, with most beneficiaries being small and medium-sized enterprises. The law also introduces debt regularisation for 2018, 2019 and 2021-2025 liabilities, offering penalty waivers, payment plans of up to 36 months, a shorter audit period and other measures to support economic activity. Vietnam clarifies reporting obligations under CbC MCAA. Finally, to Southeast Asia. Vietnam's Department of Taxation has issued official letter number 3870-CT-CS, clarifying country-by-country reporting obligations following the country's accession to the CbC Multilateral Competent Authority Agreement in January 2025. The guidance confirms that when a foreign ultimate parent entity files a CbC report in its home jurisdiction, Vietnamese authorities will obtain it through automatic exchange mechanisms and will not accept manual submissions. The letter also lists 37 jurisdictions with activated exchange relationships and instructs tax offices nationwide to apply the rules consistently. That wraps up our roundup. This week's themes show a clear trajectory. Pillar 2 is shifting from policy to mandatory local registrations and filing deadlines, from Belgium and Cyprus to the UAE and South Africa. Transfer pricing regimes from Romania to the UK are moving toward OECD-aligned, data-driven documentation, and national tax administrations are reshaping the basics of filing, from Kenya's e-invoicing push and Portugal's deadline relief to Bolivia's debt amnesty. Staying compliant means keeping up with these operational realities. Thanks for watching Regtalks. See you next time.